let's talk about Google for a minute. What's going on with Google? They are dramatically losing share of time spent. They're down to 68.9% time spent. That has been taken away from them by ChatGPT, now over 25% of time spent on search. Chatbots are taking over. What about their AI prospects? They've had some very public, very hyped embarrassments when it comes to AI. These are real headlines that have come through in the last few years with Google. The results have not matched the hype with AI. What else? AI costs are blowing out of control. We've entered the era of rock star data engineers, billion-dollar deals being cut for them, hundreds of millions of dollars being thrown out the door to get access to the best talent when it comes to AI in this race to invest, the race to be the best. And it's costing a lot on the CapEx side as well. This is Alphabet's capital expenditure over recent years. You can see they've spent, in the last 18 months alone, over 100 billion in CapEx, again in this race. Over 20% in 2025 of their revenues. That means now Alphabet is trading like an AI loser. 20% discount to the S&P 500, a 40% discount to the NASDAQ. A significant derating over the last few years. But Alphabet will be the most valuable Magnificent Seven stock in 5 years' time. Why? Let's have a look at these blue bars first. Commercial search revenue has continued to grow. Why is advertising revenue continuing to grow in the context of that huge reduction in time spent? That's because commercial search is what matters. When people are searching with an intent to buy, where they're searching where an ad can actually be served in response to that query. And you can see, in the case of ChatGPT, what are people spending time on ChatGPT doing? They're looking for information, they're researching, they're generating a whole bunch of AI images like I did with those newspapers before. And it takes a while, you've got to wait around for the results. There's a lot of time spent waiting when it comes to AI chatbots. As we have here, the quote from Google's CEO, people are accessing information in a really novel and new way when it comes to AI. And what that means, importantly, is iterative search. You ask more than one question. You might say, okay, I need a meal plan to shred in time for summer. And then you might get a meal plan, and then you go, actually, I really hate chicken. Can we swap something out? Swap that ingredient out for something else, et cetera, et cetera. You ask more than one question, which means the opportunity to serve ads is actually 3 to 5 times higher every time you ask the next question. And so Google is telling us that the rate of monetization is actually equivalent to that of traditional search. And so you have this continued growth. Next, they have a very credible and capable offering across the full stack of AI. You have TPUs at the foundation layer, the data layer, you have cloud and storage, you have AI models, and you have applications. Let's focus on those top two for a moment. We have Google, we have YouTube, we have Android, Chrome, Maps, Google Play, and Gmail. All of those have more than 2 billion monthly active users. Alphabet is actively deploying their AI capabilities into these platforms, their huge ecosystem, to get better engagement, to get better advertising revenues. And I don't even need to write down what the names of those apps are. You know what they are from looking at them, because 1/4 of the people in the world are using 7 of Google's products every single month. They also have 15 products with over 500 million active users doing the same thing, and their own AI capabilities are also kicking goals now. AI Overviews has over 2 billion monthly active users. Gemini itself has over 450 million monthly active users. Last but not least, the operating momentum continues in its other businesses. YouTube is the #1 streaming platform for video content in the US. It's 28% market share. Google Cloud Platform is the fastest growing cloud platform in the US. It's accelerating growth, it's profitable. Android itself has 86% share of global mobile operating systems. You've got the Pixel family of devices, which gives them some option value. They can integrate Gemini into that. And of course, Waymo. That has started rolling out. There's now over 250,000 weekly paid trips on Waymo. And by the way, people are paying 150 times to get that same business. In the case of Tesla, you're getting that for free inside Alphabet. They're also more shareholder friendly, as you can see, 60 billion in buybacks per annum. We're looking for pragmatic value at Antipodes, stocks that are cheap relative to their growth profile and resilience. This is a classic cheap stock relative to that resilient profile, relative to that growth. You can see it's trading at 20 times, cheaper than the other Magnificent Seven, cheaper than other large cap quality names within the US. This is a classic mispriced opportunity. Bringing it all together, Alphabet will be the most valuable Mag 7 stock in the next 5 years. The disruption risk is being mispriced in this stock. Commercial search is what matters. They're an enabler and an adopter of AI. They've got operating momentum across all of their businesses, and it's very compellingly valued at a discount to the S&P with faster growth. Thank you.
Before I get into any shocking predictions, I want to introduce you to someone. This is Bob, and Bob is a mortgage broker, a 15-year veteran of the mortgage broking industry, and Bob's customers love him. And the reason they love him is they take a complex and sometimes agonising process and make it super simple for no end cost to them. Bob's a pretty boring guy, but he's got a bit of colour over there on the right-hand side. And it's been a good day for Bob because he's just settled a property in the inner west of Sydney, $2 million loan, and under his standard commission structure, he's going to get 65 basis points of upfront commission, or about $13,000, and he's going to collect $3,000 each year, whatever that loan is outstanding. So that might explain the smile on Bob's face. Business is good for Bob, and it's good for brokers more generally as well. Today, 3 out of 4 of every mortgage written in the country is written via a broker, which is up from around 50% only 5 years ago. What that equates to in dollar terms is $6 billion of annual commissions that are being paid to mortgage brokers across the country. And the average broker earns something like $150,000 to $200,000 in annual revenue. But not everyone's a fan. Lenders, big banks and non-bank lenders alike have tried and failed to replace Bob and loosen his grip they have on their end customer. In fact, CBA in their recent results announcement talked about the fact that they see a broker-originated mortgage as 20 to 30% less valuable than one that they're able to originate directly. So they're not super happy about it. Which brings me to my prediction. And that is that the broker industry will be completely reshaped by AI in this decade. And I'm borrowing from Vihari's introduction, actually. I didn't sit to see her preso, so this is nice for me. The reason why I think this is going to happen is because the prize is so large. Not only are we talking about $6 billion of annual commission, but we're also talking about access and ownership of an end customer, which is so critical to banks and non-bank lenders alike. The other reason is that AI is good at this stuff. A large part of the value proposition that brokers provide is taking complex financial information, pulling it together, synthesizing that, and delivering that to a lending panel who can ultimately make a decision. And also taking complex financial ideas and delivering them back to borrowers and customers in a simple and easy to understand way. AI is good at that now. And the other reason I think this change is going to happen is because I think the credibility gap is closing. So as particularly a younger generation of new borrowers come through, they're going to be more used to AI being a part of all of their lives. And they're going to be comfortable with it being involved even in what might be the largest financial decision they make, which is buying a house and taking out a mortgage. So I think this is coming for Bob. And we've already seen moves here in this direction. There's already some movers at the moment. We've seen CBA partner up with OpenAI publicly as recently as August this year. Now, they've said that that's focused internally to start with, but it doesn't take a quantum leap to see that once they start to see those benefits, they're going to turn that focus outwards, and mortgage broking is going to be key in their sights. We've also had the AI providers, people like Loan Options AI and Beeline in the US, start to come out with products that are already being able to replace what mortgage brokers are able to do in a commercially viable and scalable way. So I guess the question is, what does all this mean? Well, I think the fundamental thing it means is the amount of commission going to mortgage brokers must come down. As AI continues to provide an ability for a lower cost option, competition will drive those prices down. I guess maybe the more interesting follow-up question is, who benefits from that? And so I think, yes, lenders like the CBA trying to take some of the pie there, and AI providers will scrap over that. And I think there are winners and losers in that will be able to gain true market share and collect some of that $6 billion number that I quoted. But actually, I think the true takeaway is that probably it's all the people in this room, you and I as mortgage customers, that will ultimately benefit from the imposition of AI on Bob's world, as we end up getting lower cost mortgages flowing through the system and some of those benefits accruing to us. And what about Bob? Well, don't worry. I think Bob's going to be okay. I still think that seasoned and experienced mortgage brokers will still provide an important human face to what is obviously a huge financial decision for most of us. But maybe rather than having a group of junior brokers or an offshore processing agent, we're going to have Bob powered by AI, and brokers will be the human face of what is a deeply technological solution. Thank you.
Thank you for having me back, LifeWire team. Thank you for this wonderful event. Now, let's think about our day today, or your day. You woke up in the morning, had your coffee, took a shower, hopefully warm shower, took a train to get to the LifeWire event, maybe checked your emails on the train. What you often don't realize that the vast majority of your daily activities are enabled by infrastructure. Transport, digital, water, electricity, social. Infrastructure is the most essential part of our life. From the investment perspective, it is the best asset class, sorry my equity colleagues, to have in your investment portfolio. So that made me think how you can invest in infrastructure, how our retail SMSF investors access this asset class. And I looked at a couple of reports. I found that ATO publishes overview of SMSF investment portfolios. And it's actually the only way they can invest in this asset class is currently through our global listed infrastructure. There was no mention of Australian listed infrastructure at all. And I thought there must be a good reason for this. So this chart shows us that the number of listed infrastructure companies on ASX has been declining over the last 20 decades. And we currently have less than 50 infrastructure companies on ASX. Does anyone want to guess how many unlisted infrastructure businesses we have in Australia? No? A guess? Come on. A number. 200. Close. Very close. So Macquarie research states that there are 172 unlisted infrastructure businesses in Australia. It's a growing trajectory, growing number. Several reasons. You won't be surprised hearing those reasons. Listed infrastructure companies often opt out to delist because they want to avoid short-term market pressures. We often see there is really attractive pricing arbitrage when we see public to private transactions. We saw Sydney Airport going private, AusNet, Spark, and this trend will continue. Now, today, my shocking prediction is that we will see the end of listed infrastructure on ASX, and at the same time, we will see the start of an innovation cycle that will really drive growth of new structural solutions for our retail investors in Australia to invest in infrastructure. And I'm very excited about my prediction. There are two reasons why. One, we have over 630,000 SMSFs in Australia. and they're looking after $1 trillion of assets under management, which is 1/3 of our entire pension market in Australia. Infrastructure is the best match for their portfolios, and you'd know why, because most of the SMSFs are currently in their retirement phase, and they are looking for capital preservation, income, and this is their preference versus often higher growth and high risk strategies. Now, according again to ATO, it's only 1% of their portfolios that invests in global listed infrastructure, nothing in unlisted. If we look at our Australian Sovereign Wealth Fund portfolio, and this is from their last annual report, they have 10% of their portfolio in infrastructure. The reasons are so strong because infrastructure can provide really strong downside protection. We heard today Phil King talking about uncorrelated returns, and infrastructure has low to negative correlation to other asset classes. It can deliver relatively stable income returns over a long period of time. However, Australian retail investors have really struggled to access it. We are looking at ticket sizes starting from, some Australian super funds are looking at minimum $500 million per deal right now. There is complexity, there is illiquidity, but the most important point, there is lack of unitized low entry products tailored specifically for SMSF. So that's one reason, the growth of the pool of capital that needs this asset class. And the second one is undeniable growth of Australian infrastructure or fundamentals that drive this growth, right? So if you believe in Australia as a country and its growth story, infrastructure is the first sector to benefit from it. Our population growth, digital infrastructure, we heard all about it, AI and everything, what drives its growth. Now, infrastructure is not going to be replaced by AI, right? The growth in AI will support it. What we as an investment community really need to think about is how we innovate and how we bring those solutions. And I expect in 10 years' time, what we'll see by looking at our SMSF's portfolios is that allocation to infrastructure will increase from 1% to 10%. It's a perfect match of capital needs and funding needs. And it's a perfect match of the growth story that will serve so well to Australian investors from two angles, as end savers and as end consumers. Thank you.
My prediction isn't actually a shock anymore because the previous presenters mentioned it, very positive on resources, and what I like to do is actually reinforce that positive aspect and why I think this will be a great sector for the next few years, not just the next one or two. What I like about this chart, and this is the S&P 500 relative to commodities, and it's probably at the most extreme valuation between those two. What it basically means is technology is rampant and highly valued, but commodities are not. And what I like to stress is that we're kind of possibly there back in 2000 when the same thing happened. But the factors that are coming to play, I think we'll see that reversal in favour of commodities at some point in time in a not too distant future. Right, now what's driving this? What's changed? And what's changed probably over the last couple of years are really things that are driven by geostrategic imperatives and changes globally. And I'll explain some of them. Supply chain destruction. What that basically means is that the Western world wants to reindustrialise and develop some of these key industrial supply chains that are currently driven by China back to the Western world. That's a key positive, and it's going to take years to play out. The other issue is national security. everything that has a national security element to it, whether it's military, economy, energy, etc., has got the government's attention and therefore focus, and they're going to do something about it, and I'll show you that they are doing something about it. With all this sort of political changes, what we're also seeing is a realignment of cash flows and capital flows. Especially this year, we're starting to see significant outflow out of the US, the traditional safe haven for treasuries. The US dollar has started to fall. It's down 10%, which is a big decline year to date. And when you look at the chart, it doesn't look that exciting over the next little while. It doesn't mean it won't increase in the short term, but we think the direction of travel is for capital to find another place to be more secure, etc. And that realignment is really driven by issues like tariffs, sanctions, basically economic warfare that we can read about every day in the paper. The real beneficiary of this are hard assets. Hard assets, generally historically, have been seen as a great store of value. Clearly gold, silver have always been seen as that, but commodities also tend to outperform in a falling US dollar environment. And then the general kind of demand dynamics of the energy transition, the AI, data thematic, defence spending, etc., are all drivers for this space going forward. Right, now what's all this about? I think this chart really tells you everything. And if you look at all the flows for the last 20, 30 years, all the flows of all the critical materials have been going to China. Why? Because China spent the capital on developing mines, developing processing facilities to produce the products that have driven its economic engine for the last 20 to 30 years. As you can see, it dominates pretty much every metal in every element. Now, I think probably 2 or 3 years ago, I think the US government woke up and realised that's scary. That's not comfortable for anyone, certainly not them, and they need to do something about it. And what is that? It's basically to encourage reshoring of industry and the development of those supply chains. And I'll explain that. Right. So, build the supply chains, and that's just starting. To do this is like a 10-year process, not next year or the year after. It's 10 years. So this will underpin kind of the demand dynamic for these commodities. The critical metals. Nearly every Western economy today has developed a list of critical minerals that are essential for its future security, whether from an economic or a defence point of view. There's about 30 of them, but because I'm a cynic, pretty much every commodity is critical going forward. Now, what they've done is they've created and facilitated what I call enablers. Enablers are jokingly 3-letter agencies, but not the spy agencies. The DOD, the DOE, Australia's got a critical minerals fund, Canada's got one, and what they're now doing is starting to go to work, and that is to incentivise new projects, especially in things like rare earths, tungsten, and all those specialist metals that are critical for technology or for defence. And we're starting to see that. And again, this takes years to play out. So what's the opportunity? The opportunity is resources are cheap in pretty much every valuation metric that we care to use. Despite actually the last 10 years, resources have outperformed on the ASX, have outperformed the industrials by about 4 percentage points over that 10-year period. But within that, the last 5 years have actually been a serious underperformance. But what we've noticed, this year, things are starting to change pretty quickly. And quite a lot of commodities are up anywhere between 20 and 50 and 60% on the back of that. So build the ex-China chain, a supply chain. In many cases, that chain doesn't exist. So it has to be built from scratch. So what we're really talking about is the reindustrialisation of the Western world, which is a real positive. So this will generate the regular sort of demand, but at the same time, demand that's above GDP for certain commodities. Resource stocks are cheap relative to technology. They're trading on pretty low multiples, and I'll show you that. So if you compare them to the top 7, on any criteria, they're ridiculously cheap. When you compare the big miners, they're not necessarily a great example of growth because they're big, but then again, they're pivoting to growth as we speak. But if you look at them, they're generating phenomenal dividend yield, significant free cash flow yield, and trading on multiples at lows compared to what they were back in the last commodity boom. So a lot of catalysts to go forward, a lot of things to make it attractive. So hopefully, if I can leave with you, we think we're at the start of a multi-year resource boom. I don't want to say super cycle because that generates all these other connotations. It's a very attractive setup for our space. I think probably the best one that I've seen since the China-driven boom. But this cycle will be driven by the Western world together with China, not just China. So all of a sudden, you've got a bigger play box with a lot of different players. So the story is interesting, stronger for longer, and don't miss the ride.
If I can say, probably the most shocking prediction in the next couple of years could be that we might be reaching 5% productivity with zero inflation. Now that will be truly shocking. At this point, at that juncture, there is no need for gold, there is no need for silver. We will realize that we shouldn't be worrying about government debt and what's going to happen and refinancing. And every investment style will change very dramatically. Now, that's what most technologies are discussing today as are we facing the next 5-10 years one of the worst decades ever or one of the best? And the difference is really productivity and inflation. What is a balance between the two as we go forward? Now, any general purpose technology, whether it was steam, electricity, combustion engine, whatever it was, reorganized the entire system, reorganized society, reorganized economies, reorganized everything. But it's so disruptive and so comprehensive that initially its productivity, aggregate productivity, actually goes down. This is your bottom of the U-curve. And the reason productivity goes down because neither society, no economists, no businesses know how to use this new technology. And so what happens in small areas where technology utilized incredibly well, productivity mushrooms, and that's your billionaires' factories. But everybody else dies one cut at a time. And therefore, the aggregate productivity actually goes down. Then you come to a stage, and that's your bottom of the U-curve, where societies more or less worked it out, how to do it. The businesses worked it out. And so positives and negatives of technology basically offset each other. And so productivity is not recovering, but it's not really falling anymore. And then you get to the other side of the U-curve, and this is a move from 1 to 5% productivity, where suddenly you have a massive spur of productivity occurring. Now, if you think of McKinsey reviews and all the others, they're basically discussing productivity gain over the next couple of decades of $15, $17 trillion. But what they fail to mention, and just to use example of Bob, the real estate guy, yes, Bob might be okay, but what happens to Charlie and Johnny and the rest of them? So one guy could be okay, but what happens to the rest? The way McKinsey described it is that certain adjustments would need to be made. Certain people will lose their jobs. Certain people will need to be retrained. Government policies would need to change. But in a report which goes for 200 pages, it's a throwaway line on the bottom. It's a hedge. But that's the essence of it. This is your U-curve. Only when the time when societies, labor markets, businesses readjusted would you have a very strong productivity gain. But at that stage, you probably won't have many Charlies or many jobs at all. So most of us will not be working. Certainly not in what we consider to be jobs in the current environment. And so government policies needs to change. How do you maintain aggregate demand? It's all very nice to talk about productivity gains, but what happens to the aggregate demand? Who's consuming it? Where does the income come from? And at this stage, globally, there is nobody, certainly no government, that is contemplating the right policies. What are the right policies? Universal basic income. It's being sneered at by everybody, but that is the answer. Instead of minimum wages, you have a universal basic income. Not to make people lazy, but to compensate them for their irrelevance. That is the issue. And how do you actually maintain? So to me, you have to look at that. You have to look at regulatory policies. You have to look at the curbs, how technology owned, who benefits from it, how taxation system is going to change as we go forward. Right now, that's only discussed on the fringes of academia, but it hasn't gone mainstream at all. Now, it needs to go mainstream. So whenever McKinsey talks about $15 trillion of benefits, you have to keep in mind that it ignores all of the rest. It ignores the sayings that we need to change as we go forward. So what is the probability of 5% productivity gains and zero inflation? In 2026, it's not very high at all. In 27, it's not. But the real shocker will be that by the time we get to about 3 years, when it actually comes to pass, traditionally, the gaps between the U-curves are usually 1 or 2 generations. So if you put it in a generational terms, it's probably at least a decade away. And so the next decade is going to be very violent as people react, lash out. Populists are going to win. Nobody who's in the middle or rational is going to win as you go forward. You have to be at the extremes, left or right, or whatever that is. But it will be totally shocking if it actually comes to pass. And if it comes to pass, then you have to say, okay, what are the investment styles that are going to benefit from it? As I said, it's certainly not going to be gold. It's certainly not going to be silver. It's certainly not going to be the sayings that people are thinking of as a protection against a sort of violent future as we go forward. So that's my prediction. At some point in time, we will be there. It's just a question whether it's 2 years, 3 years out, and that's your productivity boom, and that's your re-rating of shares and everything else occurring, or whether it's more like a decade away. I'm more in a decade camp rather than 2 or 3 years, but it will be shocking if it actually happens a lot earlier. Thank you.